You check your bank account before buying something you would have purchased without thinking a few years ago. The number isn't especially alarming. Your income may even be higher than it used to be. Yet you hesitate anyway. Not because someone told you to, not because your financial goals suddenly changed, but because somewhere along the way, your behavior changed before your thinking ever did. Most people imagine financial decisions beginning with careful analysis. They picture themselves weighing options, comparing costs, deciding what matters most. Reality is often much quieter than that. A payment renews automatically, rent increases slightly, groceries become a little more expensive. Financing makes a purchase feel manageable. A raise arrives, another subscription appears. A commute becomes longer because the salary justifies it. None of these moments feel important on their own, yet together they begin changing what feels normal. The common assumption is that incentives only work when people notice them. A company offers a bonus, a bank advertises lower interest rates, an employer increases compensation, and people consciously respond. That feels reasonable because the incentive appears visible. But many of the strongest incentives are almost invisible, precisely because they never ask for your attention. They simply change which decision becomes easiest. When automatic payroll deductions increase your retirement contributions after a raise, spending adjusts around what remains. When monthly financing reduces the apparent cost of a purchase, larger commitments begin feeling ordinary. When free shipping requires a minimum purchase, buying more often feels more practical than buying less. None of these situations force a decision. They simply reshape what feels convenient. That distinction matters because convenience often becomes behavior long before it becomes awareness. The visible outcome is easy to recognize. Spending habits change. Saving patterns shift. People accept longer mortgages, larger recurring expenses, or more demanding careers. Looking backward, these choices appear intentional. The hidden driver is that each decision slightly altered the environment surrounding the next one. Behavior rarely changes all at once. It adjusts through repetition. Each recurring payment makes future budgeting revolve around recurring payments. Each salary increase quietly expands expectations. Each financed purchase lowers resistance to the next finance purchase. Each subscription becomes part of the background until canceling it feels like losing something that was never essential to begin with. The incentive is no longer the original offer. The incentive becomes maintaining the life those earlier decisions created. That creates a contradiction many people recognize without fully explaining. Higher income often creates greater confidence, yet higher income frequently produces greater sensitivity to losing that income. On paper, financial security has improved. Emotionally, walking away has become more difficult. The change did not happen because someone deliberately chose dependence. It happened because every improvement gradually became something that needed protecting. Systems rarely need dramatic moments to shape behavior. They benefit from ordinary routines. Consider how many financial decisions happen without deliberate reflection. Bills are paid automatically. Investments are contributed through payroll deductions. Credit card balances are managed through recurring payments. Insurance renews. Streaming services continue. Mortgage payments leave the account each month. Grocery prices slowly redefine what a normal shopping trip costs. Very little requires active decision-making anymore. That efficiency feels helpful, and often it is. But every automated process also removes one more moment where behavior might have been questioned. The system doesn't persuade people every month. It simply continues operating while people adapt around it. This is why incentives become powerful long before they become visible. Not because people lack discipline, because humans naturally adjust to stable environments. If commuting farther consistently produces higher pay, the commute eventually feels ordinary. If inflation gradually raises restaurant prices, eating out less eventually feels responsible rather than unusual. If borrowing makes home ownership possible sooner, debt becomes part of what adulthood appears to require. The behavior settles first. The explanation arrives much later. Responsible financial habits can also become part of this pattern. Someone increases retirement contributions every year because that is considered wise. They accept additional responsibilities at work to maintain those contributions. They avoid career changes because predictable income supports long-term planning. They become increasingly reliable, increasingly stable, increasingly committed. Each decision makes sense independently. Together, they slowly reduce flexibility. This is another contradiction. The behaviors intended to increase future security can simultaneously reduce present optionality. Saving more can require staying longer. Building stability can make instability feel impossible to tolerate. Following accepted financial wisdom can quietly align someone's entire life around maintaining the conditions required to continue following it. No single decision causes this. Accumulation does. That accumulation extends beyond personal finance. Employers understand that predictable salaries encourage retention. Banks understand that long-term borrowing creates stable relationships. Housing markets reward ownership structures that encourage permanence. Subscription businesses rely on habits becoming invisible. Retailers know installment payments change purchasing behavior more effectively than lower prices alone. None of these systems necessarily require manipulation. They simply operate through incentives that fit normal human behavior. The remarkable part is not that these incentives exist. It is how rarely they need to announce themselves. People often believe independence comes from having more choices, yet many financial systems become most effective when choices remain available in theory while becoming increasingly expensive in practice. You can change jobs, but your mortgage payment remains. You can reduce expenses, but the lifestyle surrounding those expenses has become familiar. You can relocate, but relationships, schools, commuting patterns, and financial commitments have gradually formed around one location. Nothing is impossible. Everything simply becomes harder than it once was. The incentives never removed freedom. They quietly increased the cost of exercising it. That gradual adjustment explains why financial behavior often surprises people during moments of change. A layoff suddenly reveals how many monthly obligations had become permanent. Rising interest rates expose how comfortably borrowing had blended into everyday life. Inflation makes routines feel expensive that once felt ordinary. A career opportunity in another city becomes difficult not because of the opportunity itself, but because so many invisible commitments remain attached to staying where you are. The pressure appears sudden. The adaptation happened years earlier. Looking back, there is rarely a single moment where someone knowingly traded flexibility for convenience. Instead, there are hundreds of ordinary decisions, each completely understandable, each financially reasonable, each almost invisible. Together, they become an environment, and environments shape behavior more consistently than intentions ever could. Perhaps that is why financial incentives are so easy to underestimate. People expect influence to feel persuasive. Instead, it often feels familiar. They expect systems to announce themselves through rules. Instead, systems frequently appear through routines that stop feeling like choices. By the time someone recognizes how their financial behavior has changed, the incentives responsible have often been working quietly for years. Not because anyone forced those changes, but because adapting to the environment usually feels easier than noticing the environment itself. If everyday financial incentives reshape behavior before they reshape awareness, then how much of what feels like personal choice is actually the path the system made easiest to follow? Finance Simplified explores how incentives and pressure shape behavior over time.